the biggest alcohol company by market cap, isn't European, it's Chinese. It sells a premium Chinese grain spirit and delivers margins that will make luxury maisons blush. That's Kweichow Moutai. Global alcohol is facing headwinds and has fallen out of favor with investors. Sentiment is cold, multiples are compressed. In this video, we'll break down Moutai's business model, translate it into financials, and test how the company holds up against a tough macro backdrop. Kweichow Moutai comes from the town of Moutai in China's Guizhou province. The modern company dates to 1951, when the state merged three historical local distilleries into one industrial entity. The current corporate shell was set up in the late 1990s and listed in Shanghai in 2001. Beyond paperwork, the product is tied to its place. Moutai is protected by a geographical indication and a recognized traditional craft, which locks the brand, the method, and the Chishui River Valley together. The lineup is simple. At the center is the iconic Feitian bottle, 53% ABV, usually 500 milliliters, the reference that defines the house style and prestige. Around it, aged and special releases, 15, 30, 50 years, Zodiac and limited editions, keep scarcity and collectibility alive. Below that sits the series line: Moutai Prince, Moutai Yingbin, Moutai 1935, and others, opening more accessible price points without breaking the high-end codes. If you've never had it, think of a clear, high-proof Chinese grain spirit made mainly from sorghum, known locally as Baijiu, essentially China's national spirit. Moutai's production follows the traditional 12987 sequence. A 1-year brewing cycle, 2 grain feeding, 9 streamings, 8 solid-state fermentations, and 7 distillations. Inputs are very specific: red Hongyingzi sorghum for structure and starch profile, plus a high-temperature wheat-based tatu. The base spirits then rest for years in stoneware jars before a precise final blend. From grain in to bottle out is roughly 5 years, which builds structural scarcity you can speed up without changing the style. Even so, the group has gradually scaled output to meet demand. Over the past decade, sales volumes rose from about 27.5k tons to 83.3k tons, roughly a 13.1% CAGR. Part of that step up reflects the release of mature inventory built during the 2013-14 downturn, anti-corruption macro, rather than any acceleration of the 5-year production and aging cycle. On pricing, official SRP has been adjusted infrequently and stepwise, essentially a single move from 1,299 RMB to 1,499 RMB in 2018, and then held there through 2024. All of that finally shows up in the revenue chart. Demand for the group's products remains strong, translating into a steady climb in revenue over the last decade, from 32.66 billion RMB in 2015 to 170.9 billion RMB in 2024, about 5.2x in 9 years, or roughly a 20% CAGR. Because the base got bigger, volumes can only rise at the pace of Moutai's 5-year aging cycle, and prices barely moved. So from 2019 to 2024, revenue growth naturally slowed and leaned more on steady volume mix than on big price hikes. From 2015 to 2024, about 2/3 of the revenue lift came from volume, about 1/3 from pricing mix. On valuation, EV to revenue went vertical into 2020, peaking around 25x during the post-COVID frenzy, and has since deflated to roughly 9.7x based on the current share price, at a historically low level and fundamentally attractive for a company of this quality. H1 25 slowed to plus 9.1% year-on-year amid tougher comps and a softer macro. Finally, the why people pay is cultural as much as sensory. This is the bottle poured at Chinese state banquets since the Mao era, famously at the PRC's founding celebrations and at the 1972 Nixon-Joe banquet, so it carries decades of diplomatic theaters, prestige gifting, and business etiquette on its label. You don't just drink it, you signal with it. That heritage shows up in premium pricing, which translates in exceptional margins. Moutai charges premium prices while unit costs are tiny, grain plus low-cost aging. So COGS sit around 8 to 9% of sales, yielding a gross margin in the low 90s. That margin has been remarkably steady over the past decade. Brief dip around 2017, then a smooth return to 92% by 2024. For reference, Hermès printed a 70.3% gross margin in 2024, and Ferrari's implied gross margin was 50.1%. Moutai sits in a different stratosphere. With light advertising, lean overheads, and minimal distribution costs, operating expenses consume roughly 20 to 21% of sales, so EBITDA margin settles around 70 to 72%. 2016 shows a brief dip to 65% as taxes and surcharges stepped up after China's VAT reclassification. EPS has stair-stepped for a decade, from 12.34 RMB in 2015 to 68.64 RMB in 2024, about 5.6x in 9 years, a 21% CAGR driven by steady top-line growth and ultra-high flow-through from gross to EBITDA to the bottom line. That pace has naturally moderated as the base got larger, roughly 28% CAGR in 2015-2019 versus 16% in 2019-2024. In H1 25, EPS printed 36.18 RMB, up 9% year-on-year, broadly in line with the softer revenue cadence we discussed. This is a luxury product and therefore highly discretionary. With China's property prices under pressure, the negative wealth effect, and subdued consumer confidence weigh on big-ticket gifting and banqueting. At the same time, overall alcohol consumption is drifting down, especially among younger cohorts, but the drink less, drink better premiumization trend remains intact, so premium spirits keep taking share. Moutai is trying to stay culturally relevant, ice cream, coffee collaborations, smaller formats, and to expand internationally, but that's the tricky part. At 53% ABV, the product is deeply rooted in Chinese culture and polarizing outside China. Many non-Chinese drinkers find it too strong or can taste the step up versus cheaper Baijiu. So adoption abroad is likely to be extremely slow and education intensive. Net-net, the near-term picture is cyclical, wealth effect and sentiment, but the structural supports are premiumization, brand salience, and tight supply discipline. Historically, Moutai's growth has been driven more by volumes than by price. But volumes are clearly slowing. Recent years show a lower run rate. Today's output is already high for a luxury product, and production is confined to a protected appellation of only 15.03 square kilometers, so volumes can't expand indefinitely. My base case is therefore 5% volume growth per year over the next decade. On pricing, remember we are talking about the official SRP, not secondary street prices which swing around. SRP isn't adjusted every year, which is exactly why I see pricing as the biggest lever from here. If China's macro backdrop and consumer confidence improve, as I expect at some point over a 10-year window, Moutai should be able to lift SRP within a 5 to 10% per year range on average, not necessarily every single year, helped by mix. Put together, that points to 10 to 15% annual revenue growth over the next decade. 5% volumes plus 5 to 10% price mix. Now, let's flip to the financials. As you'd expect for a luxury-like spirit franchise, this is a light asset business. Hard assets are small, while most of the value is intangible. Brand, protected origin, know-how, and tight channels. This is arguably the most impressive part of the story. Over the last 10 years, Moutai has been consistently cash-rich, with essentially zero financial debt. In 2024, it held approximately 170 billion RMB of cash. That's remarkable for a distiller that must tie up capital in long-aging inventory. Peers typically use debt to bridge that working capital cycle, while Moutai funds it entirely from operations, leaving huge resilience and optionality. Capex, dividends, buybacks if desired. Capex runs mostly 2 to 4% of sales, with step-ups in 2019 and 2021-2022 peaking 4 to 6% to add workshops and storage. It dipped to 1.8% in 2023 and rebounded to 2.7% in 2024. Remember, capex today feeds volumes years later because the spirit must age. Inventory is the swing factor. Days of sales dropped to 34 in 2017, channel cleanup, then rebuilt as the aging pipeline was refilled, and stepped up to 78 in 2024 as inventory rose and customer prepayments fell. Return on equity underlines how profitable this model is, a little above 30% for most of the period, at a very high level with a peak of 36% in 2024. Free cash flow per share rose from 12.24 RMB in 2015 to 69.88 RMB in 2024, about a 21% CAGR. The sharp 2022 dip was mainly the capex spike, plus a working capital build. The price to free cash flow multiple has normalized from the 2022 peak to 20.9x on today's price versus 21.8x on 2024 free cash flow. Still elevated, but in line with the quality of the franchise. For almost a decade, Moutai paid out 50 to 52% of earnings. In 2024, it deliberately lifted the cash payout to 75%, equating to a 3.5% dividend yield. The step up is funded by a huge net cash position, modest capex, and aligns with the broader push for Chinese SOEs to return more cash. The buyback deserves credit for existing, but at roughly 6 billion RMB, about 0.3% of market cap, it remains very small. Today's price, 1,461 RMB, sits almost on the -2 sigma band of the long-term log regression. On financial year 2024, EPS 68.64 RMB, the stock trades at 21.3x P. On a TTM through H1 25, 71.6 RMB, it's 20.4x. However, that long-run regression is a blunt tool for intrinsic value here. Growth has slowed materially versus the pre-2019 trend, so extrapolating the old slope overstates fair value. That said, the method is still useful because it highlights the stock's cyclicality and high volatility. Its standard deviation around the trend line is roughly plus or minus 64.2%. We'll instead lean on a DCF with two cases. Scenario 1, 10% growth per year, 5% volumes, 5% prices, gives us 1,730 RMB per share. Scenario 2, 15% growth per year, 5% volumes, 10% prices, gives us 2,500 RMB per share. We can therefore conclude that the stock is currently undervalued relative to its intrinsic value. Put simply, Kweichow Moutai is a cash machine. Margins above those of the biggest luxury groups, pricing that flows almost entirely through to earnings, and a brand whose recognition has spent decades, very likely still around in 50 or 100 years. The financial structure is exceptional, lots of cash, almost no debt, while funding a long aging cycle internally where similarly sized players typically rely on credit to carry inventory. But there are limits. The group is ultra specialized, one single type of alcohol, Baijiu, and its international ambitions are unlikely to scale given how culturally specific the product is and how polarizing its flavor and high ABV can be. volumes will eventually hit a ceiling imposed by the size of the protected appellation. Lastly, among younger consumers, hard liquor consumption is declining, creating a risk that the brand becomes associated with the older generation if the image doesn't modernize. On valuation, the stock around 1,461 RMB trades near the -2 sigma band of its long-run log regression and 20 to 21x earning financial year 24 TTM. Or DCF cross-check on two credible paths, 10% and 15% 10-year growth, bracket intrinsic value around 1,730 to 2,500 RMB per share, indicating a discount today. As always, not financial advice. Thanks for watching this deep dive until the end. If you found this analysis useful, feel free to like, subscribe, and share. And if you are into Chinese consumer names, watch my ANTA Group video, the country's #1 in sports.